All right, let's bring on Ben here. Ben Axler, founder and CIO of Spruce Point Capital Management. Glad to have you back on, Ben.
I'm glad to be here. Thank you for your interest in our work.
Definitely, one of the things is, like always, we're all looking for informational edge. That's the way I refer to it. And that's really where it comes from. There's so many talking heads and different areas and noise out there in the market. There's truly nothing like information. And when you can actually back a thesis, right? Because anybody can talk about an opinion, buy here, sell here, but there's nothing like it when you actually have a thesis to back it up. So let's dive into a little bit more on Spruce Point Capital Management here. You guys have a proven track record of calling calls out there that are kind of more in the consumer side of things. I remember the call on Oatly. So congratulations on that one. This is something that, we got to pay attention to, because there's always going to be new kind of consumer stocks out there that kind of, I would say not deceive, but definitely kind of mislead sometimes investors to thinking a different way about their company. So let's dive into FIGS here. First things first, tell us, what did you guys see that you guys saw that maybe be misleading investors out there?
Well, thanks. So you mentioned Oatly. This has a lot of the same characteristics. Oatly sort of latched on to the plant-based milk fad, and FIGS, which is a maker of medical scrubs, had sort of a windfall in that we had COVID, right? And they took basically a commodity product and tried their best to make it a unique premium product by marketing to healthcare professionals that wanted something a little bit more comfortable, a little more stylish, different colors. And also they made claims that it had antimicrobial features that could ward off infection and the spread, which they've since retracted. But why do we like this as a short? We think the company now has no competitive advantages. So while they were first into the space, marketing premium scrubs, we now have dozens of others that have piggybacked on their success and are now offering very similar scrubs, similar colors, similar fit. So at the end of the day, you're dealing with a company that has basically one product in one market that others are entering. And so, we don't like that, right? We're looking for companies that have sustainable advantages. Now, the company had strong profits during COVID. Now we're seeing those profits start to recede. We're starting to see the revenue growth rate come down, and we're starting to see evidence that the company's subtly warning that profits could go to losses. And so that really caught our attention. And then, you asked specifically about what do we see that's exaggerated, right? We look at the revenue. We look at the revenue number, okay? When this was a private company, they had forecasted and said they had $100 million of revenues. And then when they filed to go public, they stated a revenue number of $50 million. So that's not just a rounding error. That's an extreme exaggeration of when they were private. To inflate their prospects. There's also this aspect of the addressable market. When companies come public, they love to sell investors, that there's a 10 or 20 or $100 billion market. We kind of deconstruct that and look really just at the people, the healthcare professionals that can use it, and we come up with more of a $5 billion number. Okay, and so that in context of the company's current market cap of $2 billion and a 3% market share. We think that's wildly overvalued. And then last point, before you stop me, Oatly, we had mentioned a company that embellished its numbers by misclassifying certain expenses to make their gross margins look better. We think FIGS is doing the same thing. We think they're taking distribution costs, putting it in operating expense, but when you move it up to cost of sales, their gross margins are dramatically lower. And a lot of the stock promoters want you to think that they have margins on par with Lululemon, and that's just not the case. So, we're doing that old-fashioned work, trying to come up with an informational advantage. We see signs of financial stress here with the inventories ballooning and the revenue coming down, and a management team that is prone to exaggerating and inflating numbers, and that's just not a team we want to invest in. We think it's overvalued, and we're short it.
Definitely. So I got there, no competitive advantage. the revenue concerns there. Now, I did see recently, of course, and I'm sure a lot of investors caught it also, was billionaire investor Ron Barron, right, talking about FIGS. And he made comments as you haven't heard much about it, but you will soon. He called it the Lululemon of healthcare, right? Was he more right or wrong here, and why would you think so?
Well, I mean, with all due respect to Ron Barron, he's got a great long-term track record, but we think it's wrong. I mean, we've shorted some other stocks he's been a little bit overly optimistic about in the past. You can look at Caesarstone, CSTE. We were shorting that in the 70s when he was buying it. Look, I mean, you can look at Mr. Barron's records. He was buying the stock in the 30s. And the company has been around for over a decade, okay, bear in mind. And in fact, the previous Lululemon CEO had invested, in FIGS, but they cashed out years ago, well ahead of the IPO. So this notion that they're the next Lulu, I think, is aspirational. I would say, after 10 years, we don't believe they're anywhere close to Lululemon in terms of their breadth of product, their distribution, their margins. I think it's a great way to sell a stock idea and sell an opportunity, but we think the reality is much different from the opportunity.
Yeah, one thing I always try to focus on is competitive advantage. That's really what it comes down to a lot of the times for me is, and when I try to take a look at a company, is look at the competition and see, do they truly have an advantage here, right? Is there something that they're doing that a competitor can't? And
Right.
so, and what you're clearly telling us is that there is no sustainable competitive advantage here, that maybe they might be in the limelight right now, but someone else could come in and do exactly what they're doing. Is that what you see, Ben?
Yeah, I mean, look, I encourage everyone, go to their website, look at the product, right? It's a medical scrub, okay? It's what's the different what possible points of differentiation could they have? Like maybe something a little bit more loose fitting, a different necktie, a different color. But these are things that are easily copied. They claim to have a competitive advantage in sourcing from Asia. Well, a lot of apparel companies can source from Asia. There's no barriers to going, for a competitor to go over to Asia and find a cheap source of supply and a manufacturing partner. So again, I think where the rubber hits the road here is that the market's becoming saturated. They stopped disclosing their market share 6 months ago. That's a big thing. And we always look at the fine print. If you look at the forward-looking statements, they retracted a statement about future profitable growth. So I mean, they're kind of giving you signs here of concern, and insiders are cashing out. And the two co-founders just bought large mansions in Beverly Hills and sort of trophy properties. So we question their engagement. We go to the career website. You can kind of see they're only hiring maybe 20 people. This is not a company that's on the verge of becoming the next Lulu. Otherwise, they'd be hiring thousands of people, right? They're not really growing much here. So you kind of look at all these data points and you kind of say, at almost four times revenues here, a lot of other direct to consumer peers, some of which are profitable, are trading at 1.2 to 1.3 times revenues. You put the same multiple on this stock and you get 60% downside.
Yeah, that's what I was going to point to at the end, right? Is what do you guys see the downside? And so you're saying there about 60%. That would bring it down somewhere, let's say, close towards $5, $6. And so we're looking at somewhere in there. It's at 11.27 right now. So just kind of doing a little rough estimate to take a look at it. But this company has been going straight down since the beginning, right? It's not like this has been kind of a stock that, has had, even a pandemic run, right? I mean, I think if this company would have came out maybe in the pandemic, maybe we would have been talking about some different pricing. But it just IPO'd just last year, June 27th, right? Do you feel that this was kind of more of a timing issue on why they're not being so appreciated by the market? Or do you feel this is exactly what it is? It's just they're looking into the business and not saying much?
Yeah, I mean, look, this company would be private, we think, if not for the pandemic and the story that they could sell here. I mean, we've kind of point to the structure of the company, right? They brought in a CFO, a very seasoned, accomplished one from Domino's Pizza. He left less than a year, right before the audit would have to be done for the end of the year. He forfeited $6 million of compensation. the current CFO, we think has no other public company experience. Again, the two co-founders, they now have vanity properties. We don't know how engaged they are. We just don't see this as a company that is structured in a way that's going to, bring, future revenue acceleration and profit acceleration and become that next Lulu that some people hope for. So we just kind of see this company, again, we're forward looking, we're looking out 12 months, we're reading the tea leaves. We see a company that was making profits that's going to be on the verge of losing money. And when we think that happens is when you'll start to see that stock make fresh new lows here.
Perfect. Now, the last thing, I'll just leave the window kind of open for you to talk about any other plays that you guys have put on short reports, any updates you would like to give on Skechers, Generac, or maybe some other plays.
Yeah, I mean, look, since we last talked, obviously the Fed has taken a more hawkish tone with markets, and I think you really, I think the lows are not in for the market here. We are in an unprecedented period where we've had a shock to the system with rates moving so high, and you really now have to discriminate against well-positioned companies that have defensible moats, and ones that were short-term beneficiaries of COVID and/or had some noise that made their stock go up. Now we're really going to be looking at who has real profits, real businesses, and what can sustain a retrenchment of consumer spending and housing. I mean, you mentioned Generac. Obviously, they make residential generators, backup generators for homes. Well, if your home value is going down 10, 20%, that $10,000 discretionary generator isn't as attractive of a purchase, as it was 6 months ago. And we've also had a pretty mild hurricane season here. So we're still constructively negative and short on Generac. And anything consumer discretionary, whether it be a Skechers, whether it be a FIGS, whether it be a Generac, we're still short. We're short and constructively negative on.
Excellent. I appreciate you coming on today, Ben Axler, founder and CIO of Spruce Point Capital Management. And it's something that we'll definitely keep on watch to see how the stories of FIGS develop. And of course, your other short reports that are out there. We appreciate you coming on, and we'll definitely have you back, Ben.
Wonderful. Thank you so much. I appreciate your time.